Trump's tariffs are hitting every country and they're set to cause economic, business and consumer pain. Here's what you need to know with 3 options that could save you from tariff panic. My name is Jessica Amir, a market strategist here with Mumu. It's great to have your company for the weekly on this 4th day of April. So the Nasdaq 100 is down about 17% from its record all-time high. The Aussie market is now down 10%. So the question is, what do you do now? Well, fear, it's on the rise, and we're bracing for countries to strike back with their own tariffs, and that'll probably create a full-on trade war. Canada's already hit back with its auto tariffs. We don't really know who's next, but we do know there are options for you, knowing that markets will probably fall further and uncertainties, they're on the rise. So here are 3 options for you to perhaps consider. The first thing, you could do nothing, just white knuckle it, ride out the storm and don't panic. Remember that markets, as we've been speaking about in the US and Australia, have always recovered from a market crash. But my thesis is that we could see a repeat of what happened in the 2018 Trump tariff trade war. We could see a repeat of that playbook. Now, what do you need to consider with that in mind? Well, back then, the Aussie share market fell 15.1% from its high at the time, falling to a new low. The Nasdaq 100 fell far further. Of course, it had much further to fall. The Nasdaq 100 fell 24% from its peak to a new low because these markets, of course, had to adjust for US tariffs and retaliatory tariffs. So that's one option. Brace for more pain before markets recover. Second, consider that if we do see history repeating, just as Shirley Bassey's saying, then that means the Nasdaq 100 could maybe fall 8% further. The Aussie share market might fall another 5.5%. That is, of course, if history repeats, just like we saw in 2018. And then after that crash, investors might start to get ready for a recovery. Now, in 2018, the tariff-induced trade war in the US, it only took 78 days or 2.6 months for the market to fully recover and get back to a brand new record all-time high. What about the Aussie share market? Well, the Aussie share market took a little bit longer to get back to a brand new record all-time high. It took 83 days or 2.8 months. The third scenario for you to consider is that uncertainty is the only certainty in town. And of course, what does well in uncertain times? Well, the safe havens do. Assets such as bond and gold, they're benefiting and continuing to hit new highs. So what is one safe haven that you might like to potentially consider? Well, we've been speaking a lot about gold. Gold has continued to break higher this week. It's now up 19% this year, hitting a brand new record all-time high just a couple of days ago. Now, the world's biggest gold ETF, GLD, it's also up to the tune of 19%. This ETF tracks the gold price and it physically gives you access to gold bullion. You're essentially buying gold bullion that is held in vaults in some of the world's biggest banks around the world. The vaults are held in New York, etc. Do consider that gold has pulled back, as we're demonstrating on the chart. For those that are tuning in on our podcast, we're basically showing that gold has stalled at its record all-time high. It's seeing a bit of consolidation. Many will probably be using this as an opportunity to buy gold, knowing that the case is thick for it to continue to hit new record all-time highs. It's just a matter of time before we see that potentially playing out. The other scenario that I do want you to consider is that boring long-term government bonds have become sexy. So this is a chart of a 20-year US government bond ETF. It's called the TLT. Now, this ETF is paying a yield of around 4.1%. Now, a yield is basically like a dividend, right? So that gets paid to you, say, every quarter. But you're also benefiting from the growth, just like a share. As we can see on the screen, this is showing that this ETF is up by 5%. So 4.1%, that's the yield. It's gone up by 5%. So Bob's your uncle, Fanny's your aunt. You're getting a 9% return for a boring government bond. That's not bad. So consider bond ETFs, gold ETFs. That could give you plenty of peace of mind in what is now looking like a very stormy year ahead for shares. It's great to have your company. From everyone here at Moo this week, stay safe, happy trading, have a wonderful weekend. We look forward to seeing you on Monday.